We have reached the noon hour in the Eastern time zone, and that means we're going to have our Trader Talk segment with Chart Trader today. I'm going to welcome in Brett Manning. How are you, sir?
Doing pretty good, Jim. How you doing?
I'm doing all right. Thank you so much. So you've been somewhat active on the page today, some with some trade, some with some commentary. I want to start with your overall take and your impression of what China did overnight, which I called taking the high road in some of these trade disputes. What's your overall takeaway, and how does it sum up for your posturing in the markets in general?
Well, I think we were a little bit imbalanced in terms of some of the short-term sentiment indicators, and it makes it easy to get a little bit of a pop and a squeeze on something like that. And I really do still kind of think that we're going to see maybe something above 29.50, even if this is a larger correction. I think you just have to run the highs of that range that we saw and maybe pop through the 50-day and sit in that area and get some of the short-term sentiment indicators turned around and just kind of moved into a different position or neutralized. And I would imagine we could sit there for a week or two and then start to roll back over. And I think with things rebalanced, then we would have a situation that's more conducive to actually taking out the early August lows, which I think my base case vision for this market would be to do all of those steps. And maybe this is something that's a mid to late September story when we're moving back down to take out those lows. So that's basically the way that I'm looking at this. I realized that that could be the case even when I was trying to short the NASDAQ earlier this week. But it was also the case that we could just pressure it down and push through levels. But it feels much better to kind of release some of that pressure. And I think that the headlines were a decent excuse to do it. I don't think that anything that is remotely a game changer happened. I think that the market was predisposed to an upside rebalancing move, and I think that's what we're seeing.
I don't dispute that whatsoever. I've highlighted this area between 29.30 and 29.40 where resistance just kicks in time and time and time again. And if you go back the last couple of weeks, you can see a scenario where there's lots of people that are potentially who have either shorted the market or got out of the market that are very, very vulnerable here. Now, I would think that a breakout above 29.50 might have some legs to it, and if so,
Only if that's what the market's going to do. So you get to find out. You see what I'm saying?
yes, yes. So
It's a great statement if you see that breakout, sideways move for a week, and then you move back down into that range. That's how you really allow the more bearish pattern to come into fruition, is to first do that. Exactly.
all right. So I think what we're talking about a little bit here is something similar to what you saw in gold today, where you kind of get that breakout and then you're setting up for the next selling opportunity. Is that fair?
Well, different scenarios. Either way, you've got a sort of notion of disproof of one side before opening up the other side. But I would say with equities, I think it's really my guess is that we will fail on the breakout. We will get the breakout and fail on the breakout. I don't know that that's the case, and I won't be shorting the breakout. I'm not going to be fading the market as it moves higher above 29.50, but I will have an aggressive short side posture if we see the breakout above 29.50. Not a whole lot of follow through. Some sideways movement that shows a higher level of resistance that really comes into play, looks a little bit lead blankety, and then we roll a bit back over, and I start to see the type of tape that shows me something that really matches up with a market that's ready to move down through that prior low. I think you'll see it there, and I may not see it, and in which case, I'll shift my bias, and I won't, lose any money. I won't participate. Then I will just know something more. But if it matches my expectations, we are going to be in a position that's predisposed. And just like you said, there's a lot of folks that are vulnerable up there, either getting sucked back into the market on the long side after getting out,
Mm-hmm.
or being forced out of short positions as we break out through that level. That order rebalancing, that swapping of exposure is something that the market needs to do to get out of its system, given how glaring that level is. And after that move, we would suddenly have far fewer shorts in the market and a whole bunch of new weak-handed longs. People who, got shaken out before when the market went down. If it goes back down, they'll get shaken out again. And the people who got shaken out of their shorts, they're going to get short again if this thing rolls back over. In other words, you create a lot of new potential future sellers by making that move. And that's really kind of the ideal scenario for putting yourself in play into a larger time frame short position in the market. But again, if it pops up to that level and then we're at 3,000 2 days later, that's a different market. That's
Sure.
not the thing that I'm talking about. That's nothing to treat that way. So we'll find out.
All right. So I think that pretty much sums up the analysis for the equity markets, unless you have anything else that you have that you want to highlight there.
No, I mean, that's it.
Okay.
We have a situation where people have been really hedged and really skeptical, and if we see a week above 29.50 without much follow through, and we start to see a lot of those indicators reset, we start to see SPY liquidity premium drain back down, particularly after Labor Day. We get a lot of people being willing to be back in the market, picking stocks, trading individual equities. We see put call really come back down into a more normal range for a rally. And we just kind of get a more complacent attitude that develops around a market that's really not following through to the upside. And then we start to slip back down into this range that I think you're going to be very predisposed to drop in mid to late September.
All right. So, speaking of drops, I know you're hoping for one in gold, and I'm going to use the GLD because I really couldn't get a good gold chart on my trading platform, and I didn't want to waste too much time or mess anything up. So, I'm going to use GLD as my proxy for the chart here. Now, the best time frame to look at as far as what you were seeing in gold, is that a daily, weekly, monthly?
15-minute.
I'm sorry, say that again.
15-minute.
You know what, chart? I'm having a little bit of a glitchy issue here.
Okay.
I gotcha.
You got it?
Yeah. So did you say a monthly?
No, I said a 15-minute.
Oh, 15-minute. Yeah, I'm way off, man.
Yeah.
So, okay.
Yeah.
All right, 15-minute chart in GLD. You got it, man.
Okay, so with GLD, you've got two little platform supports, one at about 144.80, one at about 143.80. This is the point where we've made a little range above these previous ranges, and we're starting to see the dollar break out, and we're starting to get some of the short interest out of the equities market. I think that given the CFTC data, we are predisposed to watch a kind of resetting or shakeout of momentum longs in gold that would be triggered by the move through the first of those platforms. So you move under 144.80, you trigger a different momentum, you start to get people chased out, and I think there's just about no way that you wouldn't then see stops triggered below 143.75 or so. And in gold futures, that's about 1433. So I'm looking for that to cascade on itself. And the question is, and this is how I really try to organize my methodology across the board. In whatever I'm trading on whatever time frame, I look for situations where I feel like I have a sort of two-level advantage. I have a bias, and right now the bias would be for a little bit of a correction in gold, some kind of shakeout. It could get much bigger than just down to 143.75, but I have a stronger short-term pattern bias that makes me feel like the market is particularly vulnerable to giving me that first step. And that gives me a probabilistic advantage in terms of where I place my risk and my odds of success, my odds of getting that move to where I've got an inside, just like we saw with the two NASDAQ shorts a couple days ago that didn't really work out. They allowed me to make money on something I was wrong about. I was wrong about my bias, but I was right about the setups. As long as that's the case, then I get the initial move. I get to move my stops up to where my risk is basically gone. I get a little bit in the bank, and then I'm open to the possibility that I get the larger move. And the larger move in this case would be a run of stops at 1,500 in gold, which would be a significantly bigger move where you're moving down to maybe 140 in GLD.
All right. I'm looking at this 15-minute chart, and I'll tell you what. This is one of the examples that I laid out with you the other day, where if you trust chart traders' bias being on the short side, and we have this potential breakout just on this 15-minute chart. We've got this consolidation right here, the last 1, 2, 3 bars or so, and we're on the verge of breaking out. In fact, we actually already did.
Breaking down.
Yeah, breaking down, breaking breaking out to the downside.
Right.
So almost like a descending triangle pattern going on, and we're
A
breaking
little bit.
down right now. So basically, this is what I'm talking about. If you can identify your setups, you don't necessarily have to take the larger the larger risk that would be assumed with well, if somebody didn't want to take a larger size risk on the initial trade because you risked
Only risk
7 points
points.
on yeah on this one right.
Yeah, right. Sure.
But on the first one, it was seven, so that's $700 per contract, and based on how you trade, you want to scale out at least three times or so. You take your first profit, and then you get your second one, and then you let that next leg run, however you want to scale it. If using just the three lot method, that's $2,100. That might be a lot for somebody. But in this case, you could do the same exact trade, the same type of trade using your own strategies and participate on that without taking the same amount of risk. So I love if people can do that. I really want to stress people try to implement that into their strategy if they feel that I don't want to take that much. So
Well, and of course, with this one, you could also just trade GLD and just trade a small number of shares
true,
if you want to
right?
risk a smaller amount. So there is
Yeah,
it's
right.
easy translation between the futures. The only what you really miss out on with that is there's a lot that can happen in gold at 2 o'clock in the morning,
Right.
and you may have a stop in GLD that simply, there could be some crazy announcement and gold opens tomorrow at 1600,
Hmm.
and your stop doesn't trigger in GLD overnight, and you end up losing way more than you wanted to. So if you're going to use GLD to take my setups in gold, take it particularly small because you don't have a stop that works. This is very much a 24-hour market, and you want to be able to be prepared for a situation where you could end up closing that trade at 149 or 150 because you get a big gap up in gold, and there's just no active and liquid market in GLD.
And I will tell you, when you see the flushes, they tend to happen overnight where there's less liquidity, and that's just the way it happens. I mean, how many times, Brett, have you taken off a trade at 1 in the morning and said
Yeah, I think,
sayonara?
and with gold, I think the particular, I mean, one of the things that we noted in the gold long in the futures a couple of months ago was really that it was obvious that the big moves, the big releases to the upside were all coming right around in front of the Shanghai Open. And it was, I mean, that's evening time, but it's still, there's not a whole lot of liquidity in GLD if it's trading at all at that point. And it was just kind of, it's something I've seen in the past, even years ago. I used to trade a lot of gold. There would be, if you have a pattern that's sort of coming to a head at the end of the U.S. equities session, and just kind of goes through a soft patch, doesn't do much, and then when you start to ramp things up in Asia, everything starts off with the manifestation of that implied movement really kind of coming to fruition right into the Shanghai Open or right around it. And that was a consistent pattern. There's been times where we've seen that around the German bond market open. It just gets really consistent.
Hmm.
And that, 2 a.m. ish, that process will become a repetitive feature in the market because people get used to, watching out for their leverage in a situation where they're going contrary to what's happening. And as they see that timestamp coming, where it's been the time the traders associate with the more manifest, more directional movement, people start to make it a self-fulfilling prophecy as that time comes close by reducing their leverage on the wrong side. So you get that kind of rhythm and a lot of time around China and Europe opens. So that's going to be tough for GLD.
What time does the LME open, the London Metals Exchange?
Oh,
Because I
I
feel like
would,
that
I
is
don't know,
where the Chinese traders tend to
probably like
gravitate
1 a.m.
towards. Okay. And I
Probably like
think that's
1
why
a.m.
you get
Central.
those moves at around that time, because I think that's when they have the most liquid access, I guess. I think they participate in
It
the
could be.
LME more than they do the US futures. So that's just
Yep.
that's just my observation over the years. But
Sure.
Uh, and it seems to make sense too. If that's where they're going to have access and they need to do something and they want to go home, they'll just do it
Yeah,
right around.
it's a tipping point. It's a tipping point phenomenon. It just takes a tiny imbalance
Hmm.
in the chemistry underlying the market to cause a feedback loop, and then it becomes established as a norm that people are expecting, and that reinforces it. And there's so many features of markets that are essentially about the metaphor that I always turn to is gravity forming in a just a big dust blanket. If you just think of like how the solar system came together, when you've got a couple of little nuggets of dust that just bind together, there's a tiny bit more gravity there than there is with any of the other disk of dust, and everything starts getting sucked toward those two little bits of dust, and it becomes 10 bits of dust and 20 bits of dust and a billion bits of dust, and then you got a planet. And it just takes a tiny little tipping point to start to get different factors to sort of congeal around it. And markets have a ton of dynamics that are really not rationalizable beyond that simple type of process. Support and resistance, I think, kind of works the same way. As people start to recognize that it becomes a feedback loop of increasing importance about some sort of dynamic. And I think that if you just have a little bit of extra liquidity kicking in at the open of the London Metals Exchange, that can certainly cause a fixed kind of phenomenon there where it's not necessary, but it's just a tipping point. It just brings something a little bit further into being the case, and people get used to it, and it becomes a kind of fixed feature of the market. And I think that's probably a reasonable hypothesis.
All right, so your first target is around 1533, or are
Yeah.
you waiting to see if it breaks through that? Would you take something off at 1533?
I don't have a limit order in. It could hit 1533 and be at 1523 a second later, in which case, I will take the extra money. So I'm going to let it play out, and that can happen with this market big time. Much more than any other market I trade, gold has the possibility, particularly when it is in this kind of situation, to have a little what you might call a flash crash move. Not necessarily a crash in terms of magnitude, but something that looks just like an air pocket, where you
Hmm.
just get all the orders on one side of the tape for a couple of seconds, and it moves up percent or two. And that happens with gold probably more than just about any other market that I trade. So I always take that into account when I'm covering a gold short, is to let that spike kind of really manifest itself in terms of what it can do.
And that means you're going to be up all night.
I'm not. I'm so sick of that with gold. I just,
Yeah.
I've done that so many times, of just like you get sucked into this drama, and it's so counter trend that I can't see myself in late August at this point doing that. If it looks so compelling, then I'll have to be on that adventure, but I don't want to. So I'm hoping that this is something that just kind of runs this course here. But you're right, it could be something where we sit at 1544 for the next 12 hours and then flash to 1510 in 10 seconds, and then we're back at 1530 20 seconds later. Um, yeah, I'm hoping not to have that experience right now.
All right. So let's move over into the euro. And this one is one that you've been short, and now it's paying off nicely. They gave you a little bit of, you had to take a little bit of heat when you first put it on. That was on, what was it, Thursday or Friday of last week?
Yeah, I think roughly.
But I do remember thinking to myself, and I didn't do it. I wanted to remind myself that, hey, if this thing looks vulnerable on Sunday night, maybe think about putting that short on, because you could get it at even a little bit better than where you initially entered it,
Yeah,
and I
well, we
didn't do
talked
it.
about it
Now
on the air too.
yeah, I know, and I'm kicking myself for it. But hey, here we are. I'm sure there's some savvy listeners out there who are with it, and it looks like it's about to break down. Where you see this one headed to?
So I think that this is the most. I think this is the most interesting trading setup right now. I really do. There's so many regulatory and political factors that can come into play, and policy factors that can come into play and contort what this actually does. But aside from being able to see a crystal ball in terms of how politicians and central bankers and regulatory authorities are going to deal with this, what I think is possible here, and this matches the notion of the technical pattern that we've talked about, where you could see a really dramatic September bar to the downside on the monthly chart. I still think that is highly likely, and it's why I'm in this trade. But I can put a logic behind it that I think is extraordinarily interesting right now, and that is there's a paradigm shift that's happening. I think it's the most important paradigm shift that's happening across markets right now. It's really becoming a popularized idea, and that is that central bank monetary policy tools, um, rate cuts, forward guidance, quantitative easing, and asset purchases, that they have sort of become a little bit impotent, and that maybe it's a larger time frame paradigm shift where we're going through the process of sort of like a tolerance is built up to the drug of that in markets on a very large time frame, and with everything so close to the zero lower bound in terms of rates and forward guidance being so non-credible when it comes to anything other than continued slogging through a highly disinflationary or deflationary environment, and quantitative easing really kind of being unmasked as being something that's really a financial market tool and not real credit in the economy. There's just a sense that the shock value of anything that a central bank can announce or do is really becoming minimalized, and we're going to have some kind of tool set to deal with the next downturn. And there's an increasing sense that the reliance is going to have to be on new fiscal tools. That's a sort of intellectual transition I think that's happening across the market right now among analysts, among large investors. The expectation that we're going to shift our locus of faith from monetary policy tools to fiscal policy tools. Now, that's particularly important for the Eurozone because the Eurozone has rules against deficit expansion for most of its member countries. That is something that precludes much fiscal stimulus. And there is no fiscal union in the Eurozone. So it really comes down to monetary policy alone. And that's one of the reasons why the ECB has been more aggressive than any other central bank over the last few years, arguably, and also why people see them as even closer to the end of the road as far as their ability to meaningfully stimulate a change in the behavior of agents in the economy, even if they can change the behavior of agents in the financial markets. So we're left with a situation where there's going to, I think, rapidly come into view a kind of crisis for the euro that we don't really see right now. And I like that aspect of this trade as well. I like the fact that it's nothing I just said is being popularly discussed, but I think that it's undeniably true. I think that we're getting to the point where the euro has the genuine possibility of being dismantled in this next cycle downturn, or we're going to have to see a fiscal union of some kind, because we can't simply let Italy do whatever it wants fiscally and run up infinite deficits, or we're going to have to meaningfully change the rules. And you're dealing with an EU Parliament that would have to deal with that has 27 different languages, 27 different cultures, and probably is the slowest moving political body in the history of the world. So I think that for all of those reasons, whether the crisis leads to greater unity or a break apart is unclear, but either way, it will probably be precipitated by some kind of crisis. And I think at this point, with Germany already starting to contract in GDP and the political consequences of weakness in Italy already starting to manifest themselves, I think that we're not far from markets starting to discount that crisis. And I think that's why we see something like news from the ECB saying there's not necessarily going to be a big QE package. You get a spike in the euro, and it immediately sells right back off to the lows. I think that kind of behavior confirms the sense that this market, which is now basically testing new multi-year lows in just a creeping fashion, I think that it is presenting the dynamic that is the discounting of that kind of process. I think that's ultimately what's happening here. And I think with the example of the UK leaving the Eurozone, apparently successfully, within the next couple of months, and that being the showcasing of the possibility for other members of the Eurozone. I know the UK had a unique relationship with the situation and didn't have the currency, but the point is it can be done. And for people who are really in a situation like in Italy, where they get to the point where the ECB doing something isn't really going to help them, and Germany is sitting there telling them that they're not really able to lever up their sovereign balance sheet, then it starts to look a lot more desirable to say, hey, what if we had our own currency back? We could devalue it like crazy, and we could really do a lot of fiscal stimulus. That's going to become a more and more compelling idea, especially since another country has just successfully exited the Eurozone. that process, I think, is something that markets are going to consider and look forward to. And I don't see how that doesn't lead to a crisis for the existence of the euro. That doesn't mean it's possible that that situation could play out and the euro not go down that much, because a break apart of the euro doesn't mean the euro is worth nothing. It means that you get a bunch of other currencies, but most of those currencies will quickly be devalued dramatically. So I think it will, in a de facto sense, people will be protecting against the idea that it is euro bearish for there to be the contemplation of a break apart of the euro. Even if none of this ever happens, I think the market's going to have to discount a risk of that process. And I think that's why we see such pressure on the currency right now. So that's the underlying kind of intellectual foundation of a euro short right now. And I think that we always get a situation where the existence of the European Monetary Union without a fiscal union comes into question on the downside of the cycle. And I think that this is going to be a particularly dramatic version of that, given the zeitgeist evolution for monetary policy, because all they really have is the ECB. They don't have a process that other countries have, which is devalue and run up large deficits to stimulate.
All right. How long does that take, though? How long does that take for a breakup?
I have no idea how long that takes, but that won't matter to people in the trade. It really will not matter at all, because it's not that you're not covering on the breakup. You're covering on the admission that a breakup is possible. I mean, I think that at that point, the whole thing becomes discounted into the market. So I think that it's...
Who would admit that? Who would be the first to admit that? IMF, maybe?
I think that I think nobody will openly make a press release about it, but I think that it
You know
will
what I mean.
become, I think that it will start to become something where, every piece of analysis that comes out from big Wall Street firms on currency markets will include a section of what are the probabilities of a Eurozone breakup. And that's, 5% right now, and it will go to 60%. And just that will be tantamount to the realization or the admission. And I think that you certainly won't hear politicians say it until there's no possible way forward other than that. And I suppose there could be an article filed by somebody like Italy, something like the Article 50 from the UK. Or maybe a referendum gets scheduled. I don't know. But there's all sorts of little road signs for the process to go from where it is now, where nobody's thinking about it, at least not openly. It's starting, I think, to contribute to market behavior, but it's not an open part of the conversation at all. It transitions from there to it being a very open part of the conversation among all parties, and for major analyst firms to be publishing percentage probabilities of it happening. The transition between those two is the move in the euro. It's not after that. It's now. So it would be from it being very back of mind to being very front of mind is the move in the currency. And I think that we're starting to see the type of tape that suggests that there's something like that going on. I mean, and it makes so much sense to me. I don't see how you can have this transition in philosophy about stimulus and not have that be an existential crisis for the euro, or maybe the catalyst to create, what I jokingly call the United States of Europe, where you get a fiscal union. You get essentially, the taxes go to Brussels from all the countries, and there's a big euro bond that becomes one of the most liquid bond markets in the world, and suddenly all of this is solved. It's all they have to do. But there's, just about 2 centuries of warfare among themselves standing between now and that. So it just doesn't ever seem to happen. And maybe that's the outcome of this. Maybe this is a crisis, and everybody having to realize that, there's huge positives. In the downside of the cycle, it's tough being Italy, but in the upside of the cycle, they get much lower interest rates than they ever would otherwise, because there's, the default risk is just taken out of the equation. So they really can have tremendous advantages in the upside of the cycle, but in the downside of the cycle, particularly when the ECB really can't do much other than push on a string, they're going to need something. And they can't devalue their currency. They can't print a bunch of money. They can't run up a big deficit. So it's pretty tricky. It kind of puts them in a trap. And this is when that sort of crisis would happen. Can you find a way, finally, after all these years, to put in place a mechanism that allows the downside of the cycle to not always be accompanied by this drama? And this time I think it's particularly acute because we have suddenly this kind of absence of faith in central banks to be able to stimulate.
All right. Well, it's breaking down now. We're trading at the session lows here in the euro. So We're gonna definitely be watching that one, and we'll see if this one cracks. Is it even conceivable that this would go to like say zero? I mean, the futures market's going down to zero. Is that impossible?
The what
The
what
euro
what?
futures, let's say. I mean, if the euro dissolves, I mean, does that imply that the euro futures just goes to zero?
No, no. As I said, you get. I mean, I think that the way that this would be managed is almost certainly that every euro you have would just be a certain number of Deutschmarks and liras and pesos, and I mean, you get
Hmm.
the component
Okay.
pieces of it. You'd still have a claim to the production of an economy through a note of its money. It just would be, I think that it just dissolves into its various components. But those components, then, there's a number of ways that can play out, and I have not done sufficient research on that. I remember some research from 2011, 2012, the suggestion that there would be two currencies that would break into a Southern Europe currency and a Northern Europe currency. But I think that doesn't solve the problem because it doesn't. You need then you need a new government of the Southern Europe countries to create a fiscal union there to allow the whole process, and they really wouldn't be able to lean on Germany at that point in terms of their fiscal breadth. So I don't know if that solves it. I think that it's more likely that it would just, and I don't know whether this is necessarily going to happen, whether it's going to actually break apart, but I think that the idea of that being a particularly acute risk this cycle will begin to be something that the market takes very seriously, and I think that it's very possible that that's not going to be too far off. So I think that that's why that escalator pattern chart and that extension and that cascade move to the downside is clear. And as far as the idea of fundamentally modeling the value of the euro as a consequence of this risk, again, I think that you'd have a lot of currencies that would instantly be devalued powerfully once the tool was offered to people. So there would be so I think that probably a lot of the components of the euro are weaker than they would appear right now when they are bound together in the euro, which would mean that the risk of breakup would be a bearish catalyst for the euro, just mechanically. I think that that's true. I don't know it for sure.
All right. One more market I want to talk to you about is crude oil. Now, we talked about a particular trade last week that didn't quite set up yet, but it could be in the making. And we had highlighted some areas to keep an interest in, and that was between 57 and 58. And I took the liberty of drawing a trend line on a daily chart for crude oil, and it lines up almost precisely. You wanted to see a break above that trend line, and then the sellers kick back in. So, are you still eyeballing a potential short setup in crude oil?
Yeah, sure. I mean, yeah, it's the same one. We've had some rather startling inventory data lately, but we've also had a new record in production from the U.S. I still like the larger pattern, and I still like that to play out. It just takes time. Like we said last time, when you had the reset that we had when we talked last week, the dip before I wanted it to dip, that suddenly that creates a longer time frame for this setup to play out. And we're going through the process now. I think that we are, maybe a week away. I don't know. We'll have to see it play out, but it's taking its time. It's moving through the process. I think that if we do pop above 5760 or so, and we hang out there for a day or two, when we start to move back down, we get back under that sloped line, back under 56, and then maybe make a lower high, then that would be the point where I would think you've got a defined risk on a swing short setup to move down and break under the 50 level. But there's a lot of things that could shift in terms of how I view that market on a fundamental level between now and then. So I'll just say that that's what I'm still viewing as the base case opportunity that I'm sort of hunting there. But there's a number of steps left to it, putting that setup on the table.
All right, and that means I'm gonna put a line in right around 58. I'm making Florida Gator colors for you so that I
There we
remember
go,
what
honey.
it is. So right around 58, just to keep it simple, because I think you had profiled something like 5760 to 58 and change, something like that. So
Hmm.
I'm just keep it very simple, make it right around 58, and then we'll know that that's what you're looking for. Not necessarily to sell it there, but to see how the price responds. You want to see it break out above and then come back down below, correct?
Yeah, exactly right. I want to. It's a little bit like we talked about with the equities market and 2950.
Hmm.
I want to see it disprove that side of the market and then resume the larger pattern structure of a bearish pattern. I want to see the larger pattern structure of a bearish pattern, which crude already has right now. It has a descending triangle with a trigger level around 50.5. That's in place. This is a leg inside of that pattern. The best way for that pattern to manifest itself from here is to first manifestly disprove the upside, to break out of that slope line, to
Hmm.
hang out there for a day or two, prove it doesn't have much in that direction, and then roll back over. And that, it's just like we talked about with the S&P in 2950. That sucks a lot of weak-handed longs in, kicks a lot of weak-handed shorts out. Those are all potential sellers as it rolls back over. Those are all, reset back in the other direction after we get in that direction, and the larger time frame pattern and the trigger at 50.5 is still in place. Only now it's a much more friendly exposure profile for shorting.
All right, and look at you, Mr. Multitasker. As you were talking, you went in with an update on the in-play page about what you did with gold. Do you want me to talk about it, or do you want the
Well, I
honors?
mean, it just got to where at this point, if it moves back up above basically my entry, I wouldn't want it. It's already started to trigger what we talked about. It's moved underneath that first plateau of support, and now, as far as I understand this market, given where CFTC data is, it should very quickly move below the second plateau of support. If it doesn't, then I don't want it.
All right. Anything else we need to highlight before we let you go?
Well, the last thing I want to talk about is just the China trade war situation, and I just wanted to make a quick argument for why I don't think that we're anywhere near a deal, despite any of the rhetoric that you hear. And this obviously could be wrong, but here's my argument for why it's a four-prong argument for why it doesn't matter what headlines you see right now. An actual trade deal, I believe, is nowhere near close. So the first point, something you and I have talked about a few times, I just want to reiterate it, because of the length of time that we've gone on with the trade war as it's proceeded, there's been a tremendous amount of media, a tremendous amount of press, a tremendous amount of reinforcements of statements of goals and objectives. And at this point, we have taken off the table the ability of either side to do a face-saving, propaganda-managed version of a deal. At this point, the general public in both countries is far too educated and knowledgeable about what sticking points each side has and where their heels are being dug in. And the only way to get a deal now is if one side or the other truly gives in on those sticking points. So it's no longer the case that you can have just a simplistic face-saving deal without ruining a political future. So, and I think that both sides are in a situation where they're not going to be interested in ruining political futures. The second point is China has discovered the spectacular utility of weakening the yuan, and it would appear as though the IMF is not going to do anything about that. I think that the reasonable stance is that that's what exchange rates are for. I think that's what was said. So that's a big deal. That really evens up the fight in terms of ammunition. The third point is Trump is trailing in major polls for the next election. His approval rating has dipped quite a bit in all the major swing states, in particular, the states that he really plotted his path to the Electoral College. I'm sure that China is aware of that. And so that puts China in a position where they can think from the standpoint of, I will take a deal with Trump if it's a good deal. If not, I can wait this out and see if, fate's going to offer me something different a year and change from now. Like, will I have somebody new as a dance partner who's going to maybe be more likely to give me a better deal? So they can really be choosy so they don't have to rush to a deal. And the last one is that as far as what economic pressure really means for this situation, it's really important to remember that the folks in Beijing aren't under any pressure at all. They're, Xi is leader for life. They live in a walled city. They control the internet. Right? They've already made the appeal that they're willing to weather a recession if they need to. And for those guys, nothing is going to change about their lives if the economy worsens. They're going to live in the same mansions. They're going to eat the same great food every day. They're going to have the same amount of power. So the people actually making the decisions in China, they may want to do what's right for everybody in China, or they may view their position as being, they may be able to justify taking a real hard line for a long time and taking them through deep waters if it's in the long-term best interest of the country. And it's a whole lot easier to justify that when nothing bad happens to you. And the people in the White House are in a very different situation. There's a likelihood that if the U.S. goes into recession between now and the next election, there's going to be a wholesale turnover in Washington, D.C., and a massive number of political careers will be ended in a blink. And there will be a whole new group in charge there. And there's much greater consequences to the trade war having negative implications economically for people in the U.S., on the U.S. side of the negotiating table, than for the people on the Chinese side of the negotiating table. And I think that's more important than what the actual economic data says is happening. It's the implications it has for the people who are actually making those decisions. So for those four reasons, I don't think that there's any way that the type of pressure that we put on right now is just that China's this close to breaking. It just doesn't make any sense. So I think that probably what they're doing with statements like they made this morning and last night is basically doing the same pattern that we've seen a million times, where they really want to draw this out. They want to buy time. And the way that they do that is they look like they're definitely willing to come back to the table. They're just like you said, they're taking the high road in this negotiation, and they want to keep that public image of taking the high road. They're not fomenting an escalation of the trade war, just the opposite. But when they get to the negotiating table, they're simply not agreeing to any of the terms. And that allows them to stay in this position. And as long as they can use the yuan to take the bite off of some of those tariffs, and as long as they're willing to weather the deep water, then they're in a particularly good position to just let this keep playing out. And I don't think that they're just on the verge of breaking. I think that that's crazy. I would think that the White House administration is probably closer to that. But again, I don't think they have the option for a face-saving deal without massive political costs. So I would imagine this continues for a while.
So what that tells me is that when you get the optimistic headline that comes out, it may set up for more shorting opportunities. Because inevitably it's going to fall out.
Which is exactly what I think plays into this entire strategy of just saying, hey, let's get to above that 29.50, let's reset this exposure profile, and let's look for this all to kind of happen again in a few weeks. And that's when you've got a rebalanced market and a market that's more vulnerable in terms of its guts.
All right, there you have it. Hopefully that was educational to everyone out there and get you prepared for what could be in the coming weeks as things really start to pick up after we get through the summer doldrums. Earnings season is not that far away. It's the end of the quarter at the end of September, so things could be really hopping at least up until after the earnings season. So we've got a nice little 6-week span where things could really heat up, Brett. So I appreciate you helping us have that outlook so that we can get prepared and try to manage our money and make some money in the process.
Sounds good. One housekeeping note. I have technically a vacation scheduled for next week.
No.
I had to take one eventually. If things are crazy, I'll probably keep an eye on stuff. So I may chime in if we get something that falls into any of the narratives that we've just talked about. I probably will.
All right. Well, that seems to be the MO of everyone at the trading desk. They always say they're taking a vacation, and I always call their bluff.
Yeah.
And you guys, always make me look really smart because you guys chime in every single time.
Yeah. Well, I mean, there's so many interesting things going on right now. It's really, I wish that I had scheduled a vacation for early June, I guess. It was a period recently where, first half of July. That was it. That was the time for me. It really was the period where I knew in advance, and I said to everybody, look, I'm probably not trading much at all the next 2 weeks. I can tell that this is not an environment where I want to be putting on risk. That was the time to take a vacation. Now there's so many interesting things happening that it's tough.
Well, I hear you, my man. Well, as soon as I get my time machine, I'll let you borrow it, and
Perfect.
You can go back in time and take that vacation you want.
Got it.
All right, my friend. Well, hey, I'll leave the line open. You see anything developing, feel free to jump right in.
Okay.
All right.
Thanks,
Thanks,
Jim.
Brett.